Okay guys, so following on from our Friday technical analysis session where we were looking for a move to the downside on Cardano, we can confirm we have indeed moved down by 8.28%. This is in line with the expectations. We had this wave 4 you see up here coming to completion here at around 1900 hours UTC on Friday, moving down to our lower range of expectation between 64.97 and 67.23 cents, and we did bottom out here so far yesterday at 0400 hours UTC with a low coming in at 65.61 cents. So it's been a pretty, volatile kind of couple of days for Cardano, and well, I don't think we're necessarily done just yet. Now, the good news is that there's still a potential for a bit of a higher push on the wave 4 before we actually come down into the wave 5. The bad news is that the higher that wave 4 goes, the lower that wave 5 will go. So in a kind of roundabout way, we actually want wave 4 to be complete, and then we just want to see the 5th wave complete. Now, the other thing with this is that if we do in fact complete this 5-wave move to the downside as expected, well, it does mean that we're going to see an additional move potentially down the line. Okay, so let's go ahead and just recap this most recent run that we've had to the upside then and see kind of what that looks like, because from our low of 0400 hours yesterday up to the high coming in here at 2100 hours yesterday, that being, 2100 hours, 69.52 cents was a 5.96% move. So I didn't talk about this, but hopefully people did kind of at least understand the videos that I'm putting out at this point to know that that would have been the long position to be thinking about, right? We would have been thinking that the long position was going to be in and around this area. We potentially would have been thinking on the higher side, we would be looking for 1.5 risk reward ratio. But again, you could have sniped this one a little bit deeper here as we started to see the reversal, specifically the bullish engulfing candle here, waiting for a better entry in and around this area after the retracement. And we could have gone long right around here. So not like timing it perfectly, but waiting for a confirmation. We could have gone, somewhere in here with the stop loss lower than the previous swing low and targeting out 1.5 on the risk reward ratio like so. Again, that would have actually played out and had taken profit already. Okay, so hopefully people saw that. If not, then you can obviously join the Discord. There's obviously a lot of traders down in the Discord server that's linked in the description that would have kind of helped kind of spot those kind of entries anyway. But hopefully if you kind of pay attention to these videos, you kind of see all those things anyway. Now, the interesting thing about this structural point to the upside, I'm going to run this down to a 15-minute time frame just so that we can see the scope of what happened here. Okay, so a really good run to the upside, okay, a irregular corrective pattern in my opinion, and then this move up into a diagonal ending down and then a finishing move up here. Okay, so this to me looks like 5 waves, and we can measure this distance by using our Fibonacci retracement tool. Comparing this over to here, we can see that in fact we hit the 1.618 with this high, which is kind of in line with our expectations, and we move down and then we finish this off with a diagonal pattern as well. So to me it looks like we completed 5 waves to the upside. Now the move to the downside here doesn't actually meet those requirements of a 5-wave move. So there's a few reasons for this. The first one obviously is we didn't hit 1.618. I don't need to measure this to know, but I'm going to show you guys just so you guys can see exactly what I see. So here we had this move to the downside. Now we hit 1.618 over here, but we actually had a bounce in the middle here. So we can see here that this is where we hit between 1 and 1.236. We actually came down briefly towards the 1.382. Now this actually constitutes more of a WX, Y, X, and Z pattern, okay, rather than a 5-wave pattern. And the other clear tell that we have is there's an overlap between this wick over here and this wick over here. Okay, so some people will look at this as clear resistance, and rightfully so, because I do think there's actually a move for rejection here to the downside. But that overlap between these two areas, it tells us that we can't be trending to the downside, not from an Elliott wave perspective. So with that in mind, we know that we're likely to move down because I do think we actually constitute the moves here to kind of see a continuation of that move to the downside. It will probably get wrapped up in some kind of string of corrections rather than something like an ABC or WXY, which doesn't really fit. Instead, you have WXY, XZ, and then potentially even an additional WXY, X, and Z pattern that might masquerade itself as the idea of some kind of, zigzag pattern. Now, the only other option that is potentially viable is that we actually have something that would be a expanding diagonal. That would basically mean that our wave 3 is greater than the wave 1, which it is, but it would also mean that our wave 5 has to be greater than our wave 3, which I don't think it is. Oh, it's so close. Let me go ahead and just check. Right, so here we have the high coming in at 68.38 cents. So I can go ahead and just move that to 38. And then the low, as you see down here, does not reach that 1-to-1, indicating that it is not a expanding diagonal. So yeah, it doesn't reach those criteria. It doesn't reach the contracting ones either. So I stand by what I said first, which I think, without measuring it, just by eyeballing it, it's a W, X, Y, X, and Z pattern to the downside, meaning that we have the correction to the upside here, a very interesting one. Take that to a 5-minute time frame here. Good move to the upside, big correction to the downside, and that one is interesting. Let's go ahead and just check. In fact, that is the low right here. That is interesting. Okay, so we'd actually park our Z wave over there. Okay, so with that being said, we then have a 3-wave corrective pattern to the upside, which looks pretty complete. Let's go ahead and do the due diligence there, just so that we can make sure that when we talk about those bigger macro pictures, they are in line with our expectations, which it does look like that. So let's bring us back to an hourly chart then. Okay, so now we know that we have a very interesting move to the upside that is in fact looking like 5 waves. We have a corrective pattern to the downside, but I'm not convinced that it's necessarily finished just yet, and we could continue to push down a little bit more. But that to me tells me that we are not yet finishing with the wave 4 here, and we still have the potential to push up higher. Now, as I was talking about the other day, we would be typically looking for a kind of wave 4 to retrace up to 38.2% up towards 50%. So basically our target range for this move to the upside is going to be 69.98 to 71.34. Okay, that is the range that we are essentially looking for. So if I remove that, we can see here that we haven't yet reached those targets. So the expectation in my mind is that we have a little bit more push to the downside, but probably find support in and around this lower range. We bounce up to complete out the wave 4. Once the wave 4 completes, we'll then drop for the wave 5. So how do we trade it? Which is the bigger question, right? Well, from here, we could potentially be thinking about short positions off the 50 SMA, that's the yellow line, or the 50 EMA, but I think that's actually higher risk plays here. So I would actually be waiting for, finding a bottom to this move, and I would be looking at trying to find support in and around where we were previously, around 66.5 cents, looking for a long there, because I think that is the kind of probably the safer play. Obviously, we wait for confirmation, but as the example goes, we do not cross lower than the previous swing low. So we're just going to put the stop loss somewhere around 65.32, and we're going to target out that low range of the wave 4. That gives us a 2.97 risk reward ratio, and is going to be how I approach this market. Now, our stochastic RSI, let's actually go bring that up. We'll talk about the MACD in a minute, but the stochastic RSI here, let's bring this into view, is looking for a bit more of a push to the upside. No guarantees, of course. So that tells us that we have not yet finished the wave 4, okay, as we were kind of talking about and as we are expecting here. But I still think that we're going to see a bit more of a wobble back down into this oversold area in line with the 4-hour time frame. Come over to the 4-hour time frame here. You can see that that stochastic RSI is overbought. So I'm expecting us to drop rather than to kind of, see that wave 4 come into fruition. Now, of course, if we do just rally up into the wave 4, okay, without this long position, that's okay. I'm not going to be, sweating the small stuff. I will just be looking at shorting from up here, stop loss above that previous high, but I would actually look to try and give this a little bit more breathing room. Now, technically, a wave 4 cannot cross higher than the wave 1. So if we wanted to be truly kind of like putting the stop loss right where we know that it would actually create a bit of a, invalidation event, then we're going to do that somewhere in and around 73.39. And our take profit is going to be all the way down here. Okay, so we can look for something greater than 1.5 pretty easy and pretty comfortably. Okay, now if we do in fact do these kind of typical movements as expected to the lower range, which gives us our weakest possible targets, then we're going to be looking between 64.62 and 63.04. So on the highest side there, our risk reward ratio becomes 1.56, and on the higher side, it becomes something like a 2.02. Okay, so again, we'll be on the conservative side. If of course the price action pushes up to those higher ranges of that waveform, well then our lower target ranges become 64.33 to 62.32. Okay, so we are looking for those kind of moves. Okay, so we're either going to be able to catch along into the wave 4. Once we're up there, we can reverse that position into a short, looking to capture that wave 5. Okay, but this is just short-term 1 hour chart kind of volatility, and so far it's kind of playing out quite nicely. The problem that we have is it is exceeding deeper than our normal expectations, and we can start to see here the potential slippage significantly further. Now, I was hoping that we would hold above 64.24. If that doesn't happen, which is very unlikely at this stage, then we are going to be into these deeper ranges once again. Now, is that a problem? I don't think it's massively too problematic. We'll talk more about that on the daily time frame, but it is one of those that's going to basically punish retail investors as per 2025, as I've been talking about. So, it's just a part of trying to play the game the best you can, using probability to your advantage. So let's go ahead and take a look at some of these other indicators then, right? Stochastic RSI, interesting spot. The relative strength index is still in bearish territory. We obviously had hidden bearish divergence as we were hitting those resistances. Again, pretty much in line with those expectations. The MACD histogram, this one's quite interesting, because it's actually showing us some bullish divergence. Okay, so that sounds good, right? Bullish divergence. It sounds really nice. So what's actually going on here? Well, we have ourselves two different angles, two different pieces of bullish divergence forming on our chart. Okay, so we have lower highs on the price action. Whilst we have lower highs on the price action, you guessed it, we've got lower lows on the price action. Now, whilst that is going on, our histogram is printing higher highs on the positive buying side. So we have lower highs on the price action, but higher highs on our histogram. Then we have lower lows on our price action, but we actually have higher lows on our histogram. You can see how these are the opposite of what the price action is doing. That tells us that there's actually a weakness in selling and a confidence coming into buying. What I'm saying though is the Elliott wave is predicting one more shakeout before we actually get a relief rally. And that relief rally will be pretty significant. We'll be probably pushing 74, 75 cents in my humble opinion. Of course, we'll refine that later. So on the kind of background data, yes, we are expecting a bit more of a wobble. We're expecting this kind of, move to the downside to kind of play on out. And then we are from there going to be looking for a relief rally. Okay, now hopefully that relief rally turns into rocket fuel and we just blast on up. I'm not going to be that optimistic at this stage, but it's something that I guess we can all hope for. But for the most part, my expectations are going to be that we have kind of a relief rally out towards kind of 70 to 75 cents. And we can see the fundamental data shifting in the background here. Okay. So positive, both kind of perspectives are turning bullish in terms of the kind of higher high on the histogram and the higher low on the histogram versus the lower high on price action and the lower low on price action. Cool. Okay, let's go ahead and roll this up into a daily time frame, because the daily time frame, of course, cuts through all that noise, and we are looking for a relief rally significantly higher. Now, the lower that the V wave goes, and if it does in fact crash down deeper than our kind of 64.26 area, which is a high probability of, then we can kiss goodbye to this idea that I have drawn out here. Okay, instead we have to look at this as a deeper correction before we get into those next new targets. That's okay. It's not the end of the world. It's just one of those things that we're going to have to readjust, recalibrate, and reassess the situation. But I'm not overly too pessimistic at this stage. Pessimism would really come in if we do come back down into the cumulative range that I've been talking about before. And even then, by the time you actually tap into it, you'd actually be more bullish because you've already seen significant damage on the price action. So although it would kind of be a bearish place to be, it would actually turn me into probably more bullish because we're right back into that accumulative zone. So let's talk about that for a second here, because we predicted 22 cents when price action was up here in March of 2022. Okay, so as we were kind of pushing out towards $1.22, I was talking about how we were more than likely going to see a 22-cent area. A lot of people called me crazy. We saw 23 by the end of 2022. We really rallied up early 2023, and then we finally saw 22 cents back in June of 2023. That opened us up to the very first area of accumulation. So if you didn't have your speculative buys down at 22 cents, you saw your first distribution afterwards coming in between 32 and 38 cents. That meant that we were going to be looking for a move at about 23.4 to 28.8 cents for accumulation. That took us up into the second most recent rally and into the kind of second distribution event. That was between 57 and 85 cents, as you can kind of see here playing out beautifully. And then the most recent accumulative range, one that I've been talking about for what felt like months because of how much we actually spent, or time that we spent down here, was between 27 and 42 cents. Basically, I was on YouTube saying anything lower than 42 cents, you want a dollar cost average and buy into. From here, we got that massive breakout into distribution happening between 101 and 137. I was hoping that we kind of see a breakout above this and push out for $2.27, but we didn't. So we hit the accumulation range and we kind of saw weakness within that. And then that opened up the next and the most current accumulative phase, which is down here between 27 and 53 cents. Now, we tapped it twice already. No guarantees that you spend a significant period of time down there. So if we do see a complete breakdown, which is possible, I do see us then tapping back into this overlap range. Okay, 42 cents becomes a possible scenario. So I want to kind of keep that in mind, but, you know, not be too pessimistic at the same time. This is why I think Cardano ADA is going to be a really hard asset. In fact, I think most altcoins are going to be really hard assets to trade until we have the ETFs, spot ETF approvals, which obviously that can is being kicked down the road. So for now, we can see really corrective patterns playing out. But, you know, as long as we don't go down lower than the previous accumulative lows, okay, so we're talking about 27 cents. As long as we stay above that, it is possible for us to have a really big breakout through a Elliott wave 5-wave pattern that is nesting like Russian dolls inside each other. And that is actually a really bullish pattern to kind of play out for. Okay, in that particular scenario, although this is lowering, it currently sits at kind of $9.48 on that kind of 1.618. So you can kind of get really bullish vibes. Now, Cardano is doing a lot of fundamental things, and I'll do a couple of videos on that in the coming couple of days or so, you know, which are gearing up for some pretty interesting supply squeeze. Right now, a supply squeeze could be one of the major catalysts, right? A lot of people kind of get their kind of, I guess, knickers in a twist and kind of get hung up on market cap being a barrier to price discovery. But unlike the stock market, the crypto market doesn't run on those typical kind of, you know, revenue drivers and a board of directors and quarterly reports. It doesn't work on any of that. The market cap is very simple. It's just your current price multiplied by your circulating supply. And so if you understand that price is actually dictating the market cap, then there's no point in looking at the market cap. You want to be looking at the price because the price is controlling the market cap, right? Now, obviously, you can't ignore supply. You have to understand supply dynamics as well. But if you kind of ignore market cap and focus on supply and you focus on demand, you think, okay, well, what's going to be moving the price action is going to be an imbalance between supply and demand. And what's going on at a fundamental level, whether that's Bitcoin, DeFi, XRP, DeFi, you know, all of the other fundamental upgrades that are going on the protocol, it actually is going to be gearing us up for, you know, an increase in TVL. That's total value locked, or just supply being locked up in some kind of yield farming mechanics. Now, in that particular case, you have a shrinkage of the supply while simultaneously boosting up the demand. Bring in midnight and you have a whole recipe here for multi-chain madness. Now, there's going to be 37 million wallet addresses that are going to be airdropped, you know, midnight tokens. And that in itself means there's going to be a hell of a lot more eyeballs on the ecosystem as a whole. Maybe a few of those will also dabble. Maybe if you say 10% of that, you know, 3.7 million people actually go ahead and create Cardano addresses, or maybe buy a little bit of ADA, right? And you can start to think that actually there is potential here for a supply shock, which will obviously simultaneously also bring in demand, which will create the imbalance, which will push price higher. So we can't rule out these kind of madness numbers when we know that the whole mechanics of everything that's going on here can be so wildly out of control. So let's kind of keep that in mind and not focus on what the market cap might be. The market cap will be whatever the price tells the market cap it is going to be, okay? Unlike what you have within a traditional stock system. Understanding those mechanics are very, very important. Specifically when you're trying to capture liquidity, right? You want to be in and you want to be out. You don't want to be left holding, and not unless, of course, you are super long term and you have long term vision. Okay. Ultimately, we're in very early days of this kind of industry, and so there's going to be a lot of failed projects, and there's going to be a handful of select winners. I mean, just focus on AOL, Yahoo, BlackBerry, Nokia, Blockbuster, right at the top of their field for a very long period of time, but they didn't stay there. Okay. Newcomers with better tech can come in. So keep your portfolios nimble, in my humble opinion. But of course, I'm no financial advisor. I'm just a guy on YouTube sharing his thoughts and opinions. And I'm going to wrap this video up right there. If you found it useful and informative, smash the like button. If you're new, subscribe, and I'll catch you all in the next one.